Hi, everyone. Thank you so much for taking the time out of your day to attend this webinar. Today, I'm presenting year-end tax planning. I'm your presenter, Lily Tran. I'm an enrolled agent, a certified tax coach, certified tax planner. I graduated from the University of Washington with over 15 years of education and work experience in accounting and taxes. I helped small businesses get on the right track, minimize their taxes, and solve their tax problems. I've been featured in Success Magazine and Bloomberg Tax and Accounting. I am the founder of TaxUsign. We've been in business for over 9 years. We are a hybrid tax firm based in Kent, Washington. We provide dedicated professional tax assistance anywhere, anytime. Our mission is to make taxes the least of people's worries. Our vision is we take a holistic approach to taxes, is about more than taxes, is setting you up for success so you have more time for the things you care about wherever you are in life. Just remember virtual tax help for whatever life throws at you. The objective in this webinar is for you to learn ways to reduce your taxable income, discover ways to maximize deduction, prepare for the recent tax law changes. The first part of the webinar, I will be covering the individual taxes, then small business taxes. Again, we'll have Q&A session at the end of the webinar. You're welcome to add questions throughout this time in the chat, but they won't be answered until then. In this webinar, I will cover several tax strategies to help you consider options you can implement and discuss with your tax advisor before the year ends. But remember, these are only several tax strategies, and there's a lot more. Individuals. Income and deductions. You might want to consider deferring income to the next year if you expect to be in a lower tax bracket. If your income is going to put you in a higher tax bracket, then you might want to consider delaying the year-end bonuses until January. You might want to consider accelerating deductions into 2025 if you expect higher income this year. And the accelerated deduction really depends whether you will be taking the IRS standard deduction or itemizing. Examples would be paying your deductible expenses such as mortgage interest, property taxes, medical bills, or making contribution to a charity before December 31st. When we are considering itemizing deduction, first we want to look to see what the standard deduction is for 2025. In 2025, the standard deduction for a single filer is $15,750. If you're filing jointly, that is $31,500 for the standard deduction. And if you're filing separately, it's $15,750. And if you're head of household, then the standard deduction is $23,625. If we're looking at the standard deduction, if you exceed the standard deduction, you might itemize. To itemize, consider bunching your itemized deduction into 1 year. Let's say we can look at the example of charitable contribution. Instead of spreading out the donations year after year, you can bunch them together in 2025, and now your itemized deduction would exceed the standard deduction amount. Then with the state and local taxes, which we're going to call it SALT here, the SALT has increased from 10,000 to 40,000. When you itemize, you can look at your 2024 tax return. If you have a Schedule A, that means you itemize. If you don't have a Schedule A, you took the standard deduction. The SALT was capped at 10,000. It increased to 40,000. But there is also income thresholds for that. Let's you're earning over $500,000, then the phase out eliminates the SALT deduction. We want to do some planning to reduce your taxable income so that you can deduct and hit the SALT deduction and then allow you to itemize in the year. We want to consider, are we going to itemize in 2025 or are we making deductions in 2026? This is a lot of planning and it does impact homeowners. Many homeowners before they got little or no benefit from the SALT because it was capped at 10,000. Now they're able to itemize again. And then those who live in a high taxes or high state income taxes may see thousands of dollars in federal tax savings. We also want to look at charitable giving. Does it make sense to donate this year or wait until 2026? Now, if you're taking the standard deduction, you might want to consider making those donation in 2026 because in 2026, as a standard deduction, you can claim up to $1,000 in charity for cash donations. Standard plus the 1,000. So you also want to consider that now in 2026, there is a zero point 0.5 adjusted gross income floor, meaning that based on your income, it's going to reduce how much you can contribute to a charity. You want to consider maybe this is a year that you want to make that contribution and really bunch up the charity in 2025 so that you don't hit the zero point 0.5 adjusted gross income floor. Example would be, let's say your adjusted gross income is 500,000 and the floor would be, let's say 2,500. If you donated $10,000, then you would take 10,000 minus the floor of 2,500. That only allows you to deduct 7,500. One way to avoid that would be a donor advised fund, which is a charitable giving account that allows you to contribute the assets to public charity, and then you receive that immediate tax deduction. A lot of planning with this, whether it's planning to donate this year or donate in 2026, depending on your situation. Family and education, we have the 529 plan. This is a tax advantage saving plan for education expenses. Many states offer deductions or credits, but Washington State is not one of them. It did expand beyond tuition to public and private, so it goes beyond that. It can now be used for qualified post-secondary expenses, and the limits is $20,000 per year beginning in 2026. The great thing about the 529 plan is that it can be rolled over to a Roth account. We also have the child tax credit. The tax credit helps reduce your tax bill for each qualifying child, and this amount is $2,200 per qualifying child. There is a refundable portion, and that's $1,400 per child may be refundable. This means that you could get money back even if you don't owe any federal income taxes. But there are requirements. The child must be under 17 at the end of the tax year. They must have a valid Social Security number that allows them to work in the US. They must be a US citizen, national, or a resident alien, and they lived with you for more than half the year. You and your spouse must have a Social Security number as well. There are income limits and phase out based on your adjusted gross income. There is also a other dependent credit where you can receive $500 credit dependent. It depends on the age. You can receive this $500 credit if your dependent is over the age of 19 but under 24 and they're a full-time student for at least 5 months in the year. We also have the child dependent care tax credit, and this helps working families offset the cost of care for a dependent while you are looking for work. You can claim a percentage up to $3,000 in expenses for one qualifying person or $6,000 for two or more qualifying person. You just make sure that they're eligible and that you're keeping the proper documentation. There are requirements as well. The child must be under 13 and caring, like they're unable to care for themselves, and you have earned income. And you have to pay for the care so you can work or actively look for work. There's also income limits for that as well. Another option too is gifting. You can gift up to $19,000 per person completely tax-free. You could gift that money to a family member that's tax-free to you. Some new tax law changes is that with the electric vehicle, as of September 30th of 2025, this tax credit has expired. If you purchase a electric vehicle, you can receive a credit up to 7,500. Make sure that the contract is signed, you paid the payment prior to September 30th, and you qualify for this. It also works on a used electric vehicle. You can receive up to 4,000. Remember, is electric vehicle. We also have the energy efficient credit. These improvements are made to your home before December 31st, and it qualifies for a tax credit. Let's think of external windows, the skylights, an AC unit, electric panels, natural gas, propane, oil, water heaters. Each one has different credits to it. The requirements is the home must be located in the US. It has to be an existing home and the it's used on your primary resident and it needs to be installed during the taxable year. If you're looking for this credit, then it needs to be installed during 2025 to qualify for the tax credit. We also have the solar tax credit. This is the last year to qualify for a 30% solar tax credit. If you've been considering going solar, this is the year to do it. If you miss the deadline by one day, you don't get the credit. And this could also be like solar panels, it could be a solar water heater, a small window, other energy systems. There is a website that you can log or look up and see what the credits are and see if it qualifies. This you might have heard, no tax on tips. The previous regulation is that tips are taxable income. Now, effective for 2025, employees, self-employed individuals may deduct up to $25,000 in cash tips, but based on certain occupation. How do you know if you qualify? Is that there were a list of 6 to 8 job categories across hospitality, transportation, personal services, entertainment, digital content creation. If you have income below the $150,000 as a single filer, or if you file jointly and is below $300,000, and you are listed in one of these categories for the occupation, then you would qualify. And this is not a webinar about how to prepare the return or what it looks like to qualify for this. This is to help you think of strategies that might applies to you for you to bring it back to your advisor and talk about them. If you're in like the health industry, you're a lawyer, you're a consultant, you're a broker, you're an athlete, or you're in the accounting tax industry, then you do not qualify to have no tax on tips. This is very important to know. If you are one of the occupation, then planning is very important here. Now, no tax on overtime. Prior to the new tax law changes, the overtime pay was taxable, but now, as an hourly, other exempt employees, you're eligible for this benefit. If you're an exempt salary employee, then you don't qualify. If you're a non-exempt salary employee, you can still qualify. You must have overtime earnings paid at a higher rate than your regular wages, a valid Social Security number, and then if as long as you're not in the healthcare, legal, financial, consulting, or performing arts, then you would qualify to have no tax on overtime. Okay, but again, there is a maximum annual deduction is 12,500 if you're individual, 25,000 if you're joint. There are income phase out based on your adjusted gross income. It's 150,000 if you're single and 300,000 if you file jointly. You must have a valid Social Security number. to claim this deduction. And an example would be like, let's say Jennifer is a non-exempt full-time employee and she earns $20 per hour. And then this year she worked an extra 10 hours of overtime each week and she earned time and a half, meaning that she earned $30 per hour. We would take her regular pay, which is $20 per hour, and then her overtime rate would be 30. That would make it an extra $10 per hour. Over the 10 overtime hours, that's $100 in deductible overtime per week. What we do is we take her deductible overtime totals, 52 weeks times $100 equals the 5,200, and then Jennifer can claim that 5,200 as the above the line deduction on her 2025 tax return. That would lower her adjusted gross income. There are some requirements of how to do this to make sure you are not taxed on overtime. We also have car loan interest deduction. This is effective in 2025. Prior, it was not deductible, but in 2025, there individuals may deduct interest paid on loans used to purchase a qualified vehicle. To make it qualify, it needs to be manufactured in the US, like the final assembly in the US. A qualified vehicle would be a car, a minivan, a van, an SUV, a pickup truck, a motorcycle, as long as it weighs less than 14,000 pounds. And the most important is the final assembly is in the US. And you can actually look at the VIN number, and there is a website that you can search online by the VIN number to see if it was assembled in the US. If it's assembled in the US, then you may be eligible to deduct the car loan interest up to $10,000. Now, deductions for seniors. This is effective in 2025. There's a lot of misleading information, especially from the Social Security Administration. You do still need to report your Social Security benefits, but the deduction for seniors is age-based, it's not benefit-based. What that means is if you are 65 and older, you may now claim this deduction of up to 6,000. If you receive Social Security but you're under 65, you do not qualify. Even if you don't receive Social Security benefits and you're 65 and up, you do qualify. Again, it's age-based, it's not benefit-based. And this is not refundable. If the deduction exceeds your income, you don't get the money back. And this is going to expire in 2028. It's available even if you itemize or you take the standard deduction. Taxpayers with a Social Security number can claim it. There are phase outs. If you're a joint filer, the phase out starts at 150,000 and ends at 350,000. And other filers, it starts at 75,000 and ends at 175. This does not eliminate your Social Security at all. You still need to report your Social Security benefits. But again, if you're above 65 years old, based on your income phase out, if you qualify, you can deduct up to $6,000. Retirement plans. If you're a W-2 employee, you might want to consider maximizing your 401k or your IRA. If you're in a lower tax bracket, you might want to consider doing a Roth conversion. A Roth is tax-free when you withdraw it. You pay the taxes now, and then all the qualified withdrawals of the contribution and earnings are tax-free. The best time to do this is when you are in a lower tax bracket. We have health accounts. You might want to consider if you have a high deductible health plan, then find out if you can open a HSA, which is a health savings account, is a triple tax saving. It can be treated as a Roth. As an individual, you can contribute up to $4,300 in 2025. If you have a family plan, then it's $8,500. If you're 55 and older, then you can contribute additional $1,000. By the time you hit 65, it'll be too late to contribute to an HSA. But in 2026, if you have a bronze account through the marketplace and it qualifies for HSA, you can definitely open that HSA. You can open it through like Fidelity, for example, and then make that contribution there. Again, triple tax savings. The money you contribute is tax free. In order for the money to grow, you have to invest it, and then it grows tax free. And then when you take the HSA to pay for qualified medical expenses, it's also tax free. If you're a W-2 employee and you have a flexible spending account, which is a tax advantage savings account that lets you set pre-tax money aside to pay for those out-of-pocket medical, dental, vision expenses, you want to take a look at the benefits to see what the requirements are, because some of them are you use it or you lose it by the end of the year, unless it allows you to take the funds and roll it over. All right, next we're going to cover the small businesses and how the taxes affect your small business. We got income expense timing. Think about deferring income in 2026 if it makes sense to you. Maybe you want to delay your invoices and get paid in January instead of December. If your income pushes you into another tax bracket, or maybe it reduces some of the tax benefits, then we want to consider deferring the income. Maybe accelerate the expenses, meaning that this year maybe you need supplies, purchase the supplies, pay the vendors this year versus in 2026. That will help reduce your taxable income. Your net profit income minus your expenses equals your net profit or loss. If you're at net profit and you see that is a lot more than what you're expecting, then instead of waiting till 2026 to pay your expenses, you pay it this month or next month. Another option is income shifting. Like with my business, with my taxable income, it brings me into another tax bracket. Then I might want to consider hiring my kids to shift the income from me to my son. We can deduct their gross wages. They can take that money and go pay for their expenses. Personal expenses is not a deduction, but their gross wages is a deduction. We want to shift the income to them, and then now they can also open a Roth retirement account and contribute to their own Roth. You just want to make sure you follow the labor laws in your state when hiring your kids, because like here in Washington State, you want to make sure you apply for the minor work permit. If your child's under 14, you have to have the judge, the school, and yourself as a parent to sign the paperwork. If they're over 14, the judge doesn't need to sign, but still the parent and the school needs to sign the paperwork. Make sure you follow the labor laws for that. Equipment and asset purchase, there's different types of depreciation. There's three types. We have regular depreciation, we have Section 179 deduction, and bonus depreciation. Depreciation is basically the accounting method used to decrease the value of an asset over the useful life due to the wear and tear. Let's say example is I purchased this laptop for $5,000 and the useful life is 5 years. I can deduct the regular depreciation is I deduct 1,000 in 2025. Next year, I deduct another $1,000 until I reach the 5 years or the 5,000 is gone. So that's regular depreciation. Section 179 is I increase the maximum amount. I can deduct the 5,000 this year. If that helps reduce your current income, you might want to consider the Section 179. Bonus depreciation is back where you can deduct 100%. It allows the businesses to deduct a larger percentage. Instead of spreading over the 5 years, for example, then I would take more or all of it now. We want to make sure that with bonus depreciation, all the properties acquired and placed into services happen after January 19 of 2025, but before December 31st. To qualify for any of these depreciation, You have to buy and place it in service before December 31st. Business deductions and credit. We have the home office deduction. If you use part of your home exclusively for business, there's two different method, which is simplified method or the actual expense method. You take the square footage of your home office and the square footage of your entire home. That's the simplified method. The actual expense method is that plus, let's say, your mortgage interest payments or rent, your property taxes, utilities, but home office deduction, if you're going to consider the actual expenses, you definitely want planning to see does it make sense to do the actual or do we want to itemize on your tax return? Vehicle expenses, you want to track all your expenses. If you were to take the actual expense method, you'd want to track your gas, your repairs, your insurance, your depreciation, your lease payments. You want to track all your mileage, then you do the calculation. The standard mileage rate is very simple. What was the total business miles that you drove times the standard IRS rate? That's the mileage. Otherwise, you track all your expenses, track your mileage, and then that's the actual expense method. We also have qualified business income, QBI deduction. It allows eligible self-employed individuals and owners to pass through businesses to deduct up to 20% of their QBI on their personal taxes. But if you're in the health industry or you're a lawyer or accounting or actuary consulting, then you don't qualify. It depends. There's limitation on how much you can qualify for the QBI deduction. This is where planning comes in. There are phase out based on your income. If below, then you would qualify. But if you're in the phase range, then there's partial deduction. And then if you're above the threshold, then there is no QBI. Other credits you might want to consider is research and development. And this is just a government incentive that rewards businesses for innovation. If your company is spending money developing new products, processes, software, or improving existing ones, then you can reduce your tax liability to receive a cash refund. This is very specialized. ADP, Gusto can definitely check to see if you have R&D credit. ADP is great. ADP is a payroll provider company, and they actually will print out a report and show you how much you qualify for R&D credit. And you just provide that information to your tax preparer. There's also the Work Opportunity Tax Credit. And this is like a US federal tax credit available for employers who hire individuals from a certain group. If you hire someone who's a veteran or a long-term unemployed individual or someone on SNAP, like the food stamp, or ex-felony, a summer youth employee in the empowerment zone, they would be part of the certain group and you can get a work opportunity credit. It's typically like up to 2,400 for a new hire and then 9,600 for certain veterans. But the amount really depends on like the group, the hours worked, and the wages paid. Might want to consider retirement plans. Definitely, you don't have to be wealthy to have a retirement account. You can this up yourself using Fidelity, for example. But there are many different types of retirement accounts. I kind of listed a few here. We have a SEP IRA, which is employer contribution. The employer would contribute to your SEP IRA. You can be a sole proprietor. You can be a single member LLC, a PLLC to qualify, even with a simple IRA. A simple IRA is an employee contribution plus an employer match. Again, if you file like as a Schedule C filer, you can qualify for this. There is also a solo 401k. There's a lot more available. Again, you can open a retirement account yourself and invest the money and let it grow, or you can work with a financial advisor. Sometimes I work with clients and their financial advisor, and we can sit down and determine which one makes sense for you and how much you can contribute, that we can make sure that we avoid any penalties and interest if you're over contributing, because there are limitations for this. I do want to throw in this compliance requirement with the 1099s. 1099s are basically when you have a individual or a business that you paid in 2025 $600 in cash or check, $600 per person per year, then you may be required to issue them a Form 1099. Now, in 2026, that threshold is increasing to 2,000, but in 2025, we do want to look to see who you have paid $600 per person per year and identify them and request that they fill out a Form W-9. And then from that form, we can determine whether we need to issue them a 1099, which is due in the following year in 2026. For the Form 1099K, you only need to worry about this if you are like one of those third-party payment processing companies. But typically, like if you are paying someone who paying an individual or a business by credit card, you don't need to worry about issuing a 1099 because those payment processing companies will issue it to them if you paid them $20,000 in gross payment and it's 200 transactions during the calendar year, then they would receive one. Keep in mind that if you, as a contractor for a company, that if you don't receive these 1099s, that you still report the income because that's what the IRS cares about is if you receive income, you're reporting the income. Some year-end tax tips is one is review your estimated tax payments. Estimated tax payments is those payments that you make every quarter to the IRS, especially if you're self-employed. Check to make sure that if you do owe any additional taxes, this is time to do the planning to see if you might owe. We want to look by April 15th. The goal is not to pay more than $1,000 because once you hit $1,000 or more, you may be faced with penalties and interest. But if you have those estimated tax payments vouchers and you make those payments, and even if you owe more than $1,000, if you made those payments, you're okay. You won't get hit with those penalties. But if you're a W-2 employee, we want to make sure that you're adjusting your paycheck withholding if you need to avoid penalties. Bookkeeping is very important, especially if you're a small business owner. You want to make sure that you're reconciling all your bank accounts, you're reviewing your books before you're in, because bad books will make your tax returns inaccurate and you might be overpaying or underpaying in taxes. Make sure books are reviewed if you're doing your books yourself. Make sure it gets reviewed by a professional. If you have a bookkeeper, definitely have it reviewed too, because even with our team, we have many staff reviewing our work because that's how we catch mistakes. We also want to review the retirement and HSA contributions before year end. With the retirement, there are some retirement accounts that we want to make sure that we open it before year end and you make those contributions. Sometimes some retirement accounts required to be on the W-2, like a simple IRA. If I have an S corporation and I have a W-2 employee or myself, right? Then those, like a simple IRA needs to be run through payroll. And then HSA contribution, we want to make those contributions before the year ends. You want to also consider like entity selections. Let's say maybe you're a Schedule C filer, like a sole proprietor, single member LLC, PLC, and your net profit is quite high. And we want to consider like we look at the whole picture, your business and your individual taxes, all of that in combined, all the income combined to see what makes sense when it comes to selecting the entity? Or is it better for you to stay as a sole proprietor, or should we look at a S corporation or a C corporation or partnership? I do want to share some upcoming events here. You can go onto our website at taxusign.com and you can see our upcoming events. If you're not a client and you want to become a client, Ted will put a link in the chat for you to schedule a complimentary phone consultation. I know there's going to be a lot of questions. I do want to leave time for questions. If you have any questions, you're welcome to put it in the chat or you can unmute yourself and ask your questions.